This
parameters
conference will
about
now
it,
be recorded.
and I want you to submit your questions to me because I'm sure you're going to have a lot, and I'd like to kind of clear some of those up for you. So on this first slide, you see this property over here to the right, and it looks like it's really run down and raggedy. It reminds me of houses in and around rural areas in Louisiana. We call them shotgun houses because you can open the front door and the back door and you look straight through and shoot a gun all the way to the backyard. And they're typically kind of really small and run down. And right now in Louisiana, and for the past couple of years, we've considered these homes to be of historical value because a lot of them were around plantations and in and around New Orleans. And so there's been this, I want to say, vibe to restore some of those properties. So on the right, you see what it looks like after. Now, unfortunately, I do not have any inside pictures of this property, but you can only imagine if it was built in the 1920s and it's been restored now, how old and dilapidated it was when they first got this property.
Hey, Monique, can you hear me?
Yes.
So Natalia is asking if you would put it into presenter view so that your slides would appear larger on the screen.
Oh, okay, sure.
If you'll go down to the right corner of your screen, over bottom right, you're almost there. Go to the right. You'll see a presenter view. There, to the right. One more. There you go. That'll make the image as large as possible for us out here in TV land. Thank you. Perfect.
Okay. Okay, so let's look at the qualifications, and we have two types. So first of all, this has to be a property that is someone's primary residence. These two types of mortgages can only be used as someone who wants to live in the property. A few weeks back, we had a class on rehabs for investor loans. Well, these loans, the conventional style, Fannie Mae home style renovation and the FHA 203 rehab are only for people who want to live in the property. And so right now, due to COVID, these numbers are where they are based on the changes. So the minimum credit score right now for Fannie Mae home style renovation is a 640. Prior to COVID, they could go down to a 620. And depending on the other financial factors of an individual's profile, it could go even lower. You'd have to go and run what we call an automated approval through DU, which is Fannie Mae's desktop underwriter program. So it used to be a 620, but now it's a 640. Now let's talk about debt to income ratios. And the numbers that you see are the absolute top max debt to income ratios. So it's the back end ratio. We're not talking about the front, which is typically the housing ratio, but the total debt number is 36, or it can be 45, depending on the renovation budget and the other assets that the individual may have. Now, the down payment right now is 5%, whereas prior to COVID, it was 3%. You could actually do a 3% Fannie Mae home style renovation prior to COVID-19. And typically what we see when we get an automated approval is 2 months in reserves of principal, interest, taxes, and insurance. So if your monthly payment was supposed to be $1,000, the borrower needs to have at least $2,000 in the bank sitting somewhere, and it doesn't have to be in a checking account. It can be in your retirement savings or a 401k or, you know, some other kind of liquid asset. Okay, and then on the loan amount for conventional, the max loan amount for this area $417,000. That's a lot of house. The typical house in Montgomery and Harris County, average size is about $200,000. So that is a lot of room to work with. Now, if you want to see the full guidelines for Fannie Mae and this product, you can click on the link below and it'll take you to the page that has all the details about the Fannie Mae guidelines for the home style renovation. Okay, let's talk about the FHA product. So the FHA product is called a 203K. Now, typically when people purchase a home through FHA, you're going to hear them call it a 203B as in boy. But these products are the 203K. And their minimum credit score is a 640 right now. But prior to COVID, you could see scores down to a 580 for FHA, because typically they're looking at the same kind of credit criteria that all of the FHA products carry. Now, FHA is a lot more lenient in that they allow ratios to be 41 or 55 dependent upon the rest of the credit profile. So on a credit profile where it's very thin, they don't have a lot of assets, and the underwriter cannot find a lot of stability, they will typically limit you to 41% max total debt ratio. But on a file where you have lots of assets and you have really good income and the property type is, the renovation budget is very limited, and we call those limited 203Ks, they can go up to 55% debt to income ratio. Now, here again, it's a very low down payment because it's the government product, and they will accept 3.5% down. That's not a whole lot. So when you look at the average house in the Houston area and you're saying 3.5%, that's $7,000 as your down payment on a $200,000 house. I think that's a great deal. Here again, they're looking for the same type of reserves. They want 2 months principal, interest, taxes, and insurance, or whatever DU's approval will accept. The max DU approval that I have seen personally is 54.999%. I haven't seen anything over that. And for Harris County, the max loan amount is $331,760. Now, every county is different. And when you go to that website, you can also go and look for the counties surrounding Harris County and plug in Montgomery or Fort Bend, and it'll tell you what the max loan amount is for those counties. Okay, so let's talk about the property types for the conventional product. Now, most people think, okay, I want to renovate a property that I'm going to buy. And right off the top of your head, you're going to say, okay, I'm just one family. Well, I only want a single family house, 1 unit. But the conventional product, somewhat like the FHA, they will allow you to do various types of units, including manufactured homes. So if you had someone that was wanting to renovate their property or buy the property that they are renovate the property that they're buying, and it's more than one unit, they are more than welcome to do so, depending on, their financial picture. And the guidelines here, let me move my screen over so I can see. They have varying guidelines for each type of unit. So for a 1 unit, and this is a manual underwrite, this is not an automated. If you had a 640 credit score and you're looking at 1 unit, if your debt to income ratio is below 36%, they're not even asking for any reserves. But look at the 2 unit property. When you slide over to the 2 unit property, your debt to income ratio is 36%. Your minimum reserves is 6 months, because they know that you are planning on renting out the other units to support the mortgage. And the same thing goes for 3 to 4 units. And look at how the credit score changes. The credit score for a 3 to 4 unit is a 660 with 6 months reserves. So if you have someone who's thinking, I might want to become an investor, but I want to live in one of the units, this might be a good option for them. They can purchase the property, renovate not only the unit that they're living in, but the other units, and then lease it out. And then maybe after a year or 2 years, they might want to try another type property. But this Fannie Mae Homestyle product gives them some options that they may not have considered before. In Montgomery County, we have a lot of people in the rural areas who want to purchase manufactured homes. And this is a great tool for them because it's not a lot of expense to purchase a manufactured home. But what you run into is that some of the homes need a little bit of work. They need to be updated because they might be older. So they could purchase a manufactured home and do the renovations all in one. Now, let me caution you about manufactured homes. Okay, typically what we see is the home needs to be less than 15 years old, and the budget cannot exceed 25% of the sales price. So if you have a manufactured home and you're buying it and it is $100,000, 25% of that is $25,000. So your repairs could not exceed $25,000. Any questions? No? Okay. So let's go on to the FHA 203K guidelines. Now, similar to the Fannie Mae guidelines, FHA also has things that they can and cannot, you are not allowed to work on. And some of these things that you can are things like structural alterations and reconstruction. You can modernize a property and its function. If you're there to try and eliminate a property that has some health and safety hazards. Let's say you're buying a property out in a rural area and you want to update the septic system, put in a new septic system. Or if you want to repipe a home that you're buying and replace the plumbing. You want to replace the roofing, the gutters, the flooring, major landscape work. Not anything minor like cutting the grass. That's not something that they would cover because it's not going to add value to the property. Or if you want to make some energy conservation improvements. I see people in my neighborhood all the time putting in solar panels. Okay, let's talk about the property types for FHA. So for FHA, they will also allow the single family 1 unit, but they will also allow the 2, 3, and the 1 to 4. But I do not see manufactured homes on here. Not for the 203K guidelines. The 203 requires that the property be a property that is already existing and just needs a little bit of work. 203 is limited to these units and not manufactured homes because FHA considers those to be a little bit more risky. Oh, sorry about that. Okay, so let's talk about where you can find this information to help your borrower, because what's going to be required is that your borrowers basically coordinate with the contractors that they are planning on using. It would be better if you did this prior to writing a contract, because the length of time that it takes for any of these rehab products to be reviewed, processed, underwritten, approved, and then executed by the lender, the title company, and the broker, I would not write a contract for any less than 45 days. And that's in a perfect scenario where everyone is on the same page, there are no weather delays, no shortage in materials, no problems with title, and you really want your buyers to understand what could potentially come up. And so I encourage the buyers and the realtors to go to the FHA website and input their information into the calculator just to make sure it's not going to exceed what is acceptable for the 203K. Or you can just reach out to one of us here at Jackson Henry and we'd be happy to do it for you. Another thing that you want to do is when you're looking for the contractors, you want to ask your contractors if they have ever worked on any of these mortgage renovation type products. The contractors need to be counseled and advised on how they need to structure their repair estimates. Typically, the underwriters not only want to see a detailed breakdown of the work that's going to be required, but they want to see it in terms of the work performed for labor and the cost for that labor for a specific task. And then they want to see right next to it how much the materials are and what materials were being used and the cost for those materials. They also want you to ask your contractors to include any type of permit cost associated with the repairs. And if you're not using a general contractor who may have his license and insurance and or bonding, if you're not using a general contractor that has that, you need to make sure that any of your vendors, if you're just hiring individual vendors, that they also have licenses and insurance and some type of guarantee that if there's a problem with the work, that the homeowner will be protected. Okay. Another thing you want to look at when you are going through advising your clients that they may be able to use a 203K or a Fannie Mae home style renovation is that they look at the property in terms of the cost. Because FHA has 2 tiers for the different types of products. The 203K limited is just what it says. It limits you to no more than 15% of the property's cost in renovations. If you go above the 15%, then that's considered an extensive renovation. And FHA will require that an additional party be involved. They call them 203K consultants. And on the website, when you go, there's a list of people in the area that are rostered by FHA and approved to review your project when it is an extensive renovation. So let's take, for instance, in the Harris and Montgomery County areas, you have a $200,000 house and the renovations are more than the 15%. Let's just say they are 20%. So that's a $40,000 cost. You're going to have to hire one of these FHA consultants to review your project and go through your repairs with the contractors or with the vendors that you have selected. They will review the plans for your project. They will discuss those with the contractors to get a lot more clarity. In their review, they're going to look to see, is this a doable project within the timeline allowed by the contractor? These people are licensed and they've been doing this for years. So they're going to look also to make sure that your contractor is providing you with accurate information. They're kind of a second eyes for FHA to make sure that the costs are not inflated, whether it be labor and or materials. And this additional review is going to take a lot more time. So if your project is more than 15% of the total purchase price, then you can add another month onto the process to obtain one of these 203Ks. So instead of being a 45-day contract period, you're looking at about 75 days. Not a whole lot of lenders not a lot of sellers, unless they have had this property for a long time, haven't been able to get rid of it. Not a lot of sellers will want to sit on a property for that amount of time. So I just want you to put that out there up front, and you may want to discuss with your trainer or broker additional language that may be included to accommodate for any delays, maybe in special provisions. I know that FHA does have in their financing section, when you're talking about these loans, that the property needs to appraise for X amount of dollars. If it does not meet the sales price, then they have to reduce the sales price. The seller has to agree to reduce the sales price to meet FHA's rules. So I did not see that kind of language anywhere for the conventional product, but FHA does provide that protection for its buyers. Okay. So do you have any questions for me about either one of these products that I did not cover? I didn't see anything in the chat.
I'm hearing a beeping noise. Is anyone else hearing that, or is it just me?
Yeah, I'm hearing that as well. I'm hearing that beeping noise as well.
Okay,
I'm pretty sure
thank
it's
you.
people coming in and out of the meeting, and it's on the presenter's computer that I'm hearing it from.
But the number of people coming in and out is still staying at the same number.
Okay, so that's all I have in terms of detail. I really want to get some feedback from you.
My only question is if there's an alternative to hard money loans here for investors, or is this just both of these products are just for people who will be using these properties as their primary residence. Is that right?
Right.
Am I understanding
These properties, these two types of loans are only for individuals who want to purchase this, use this for their primary residence. The investor loans are something totally different. Okay, so Santo asked a question about what does the process look like after closing? So when you do a renovation budget, let's just say it is the 25, it's 25% or 20%, and you have $40,000 in repairs that needs to be done. You're going to take 25% of that from the initial budget, and that's going to be given to the contractors at closing. They're going to begin the project. And as they go through the process and they complete it, there's going to be an inspection performed by either FHA or Fannie Mae. Once they've gotten that portion finished, then they receive another disbursement, kind of like a construction loan in a draw. Once they've received all the funds and all the work is completed, if there's anything remaining in the escrow account that's held at title, those funds are then applied to the balance of the loan to reduce the principal limit.
Now, who pays the interest on these loans, or how are the payments made? So once the loan closes, the homeowner have to pay the interest, or is it like a one-time close where the builder's paying the interest? Who pays the interest and who makes the payments on this while the construction is being done?
Well, typically there's a holdback, there's a reserve that's held in the escrow account with the title company. And the clients, the borrowers, are not required to make any payments during this construction period. So if it takes a month or 2 months, those funds are already withheld at the title company for those payments to be made.
Thank you.
Mhm. Yes, I will put these slides in Back Agent so that everyone can look at them. And I'll go back to this slide right here with the link. So if you want to either write this link down or copy the link, you're more than welcome to do so. Let me make it a little bit bigger. Does anyone have any more questions about these products? Okay, Frank. I guess I'll put these into back agent and everyone can just keep it for their own benefit.
Sounds like a great idea. Appreciate all your effort in this class, Monique. It was great content.
Thank you, Frank. Thank you, everyone.